Moving averages are the most widely used tool in technical analysis. They are also the most widely misused. The version most traders know goes like this. When the 50-day crosses above the 200-day buy, when it crosses below sell, golden cross, death cross. It sounds clean. In practice, these signals lag so far behind price that by the time the cross happens, a significant portion of the move is already over. And sometimes the move is completely done. That is not a reason to abandon moving averages. It is a reason to use them for what they are actually designed to do. Moving averages define trend. They filter out noise. They act as dynamic support and resistance in trending markets. When used correctly as a framework, not as mechanical buy and sell triggers, they are indispensable. AI makes using them correctly much faster. Two types matter for most practical work. The simple moving average, SMA, averages the closing prices over a specified number of periods, weighting each day equally. A 50-day SMA takes the sum of the last 50 closing prices and divides by 50. It is smooth but slow to react. The exponential moving average, EMA, applies more weight to recent prices, making it more responsive to new information. A 20-day EMA will respond to a sharp move faster than a 20-day SMA. For short to medium-term analysis, EMAs are generally more useful. For longer-term trend identification, SMAs are the standard. The key moving averages most professionals watch: the 20 period for short-term trend, the 50 period for intermediate trend, and the 200 period for long-term trend structure. These three levels together tell you which time frame of trend is in control and where the important dynamic levels are. Prompt 1 uses moving averages to define where price actually stands in its trend. Pull up a chart with the 20, 50, and 200 period moving averages displayed, or paste your OHLCV data. Use this prompt using the 20 period EMA, 50 period SMA, and 200 period SMA on daily data. Analyze the current trend structure for this stock. Tell me, is price above or below each moving average? Are the moving averages properly stacked, 20 above 50, 50 above 200 for an uptrend, or the reverse for a downtrend? Or are they tangled, which would indicate a range-bound or transitional market? For each moving average that price is currently near, calculate the distance between current price and the average, and assess whether price is extended relative to historical norms or whether it is close to the average. Finally, describe how long the current trend structure has been in place. Moving average stacking, where each shorter average is above the next longer one in an uptrend, is the cleanest sign of a healthy trend. When they are properly stacked, pullbacks tend to find support at the nearest average. When they are tangled, the market is in transition and the trend signals are unreliable. From the trend structure analysis, extract three things. Trend health. Properly stacked moving averages in an uptrend mean the trend is intact at all three time frames. A stock with price above the 20, 50, and 200 in proper order is in a confirmed uptrend on the daily. That is the environment where long setups have the highest probability. Extension. How far above the 20-day EMA is price currently? When price is 20 to 30% above its 200-day SMA, it is extended. Extended does not mean broken. Trends can persist for extended periods, but it does mean mean reversion risk is elevated and chasing is dangerous. The better entries come when price has pulled back toward an average. Duration. A trend that has been intact for 18 months is a different animal from one that just set up 3 weeks ago. AI will tell you how long the structure has been in place. Older trends have more established institutional participation behind them, which means more motivated buyers at the moving averages. Prompt 2 tests how well the moving averages have actually acted as support and resistance during this trend. Not every stock respects the same moving averages. Some stocks bounce consistently off the 20-day EMA. Others ignore the 20 entirely, but honor the 50-day SMA with near precision. You need to know which averages this specific stock responds to. Use this prompt. Over the past 12 months, analyze how this stock has interacted with its 20-period EMA, 50-period SMA, and 200-period SMA. For each moving average, count how many times price approached within 1% of the average. How many of those approaches led to a bounce versus a break, and what the average magnitude of the bounce was when it held. Identify which moving average has served as the most reliable dynamic support or resistance level for this stock, and whether that reliability has been consistent throughout the period or has shifted over time. This analysis gives you a stock-specific playbook. If the 50-day SMA has acted as support 8 times in the past year with price bouncing an average of 7% before failing, that is a trading pattern with a measurable edge, not a theory. The dynamic support analysis produces a concrete trading framework. The preferred level. Every stock has a moving average it tends to respect most consistently. It is not always the 50-day that everyone watches. Some high momentum growth stocks ignore the 50 entirely and only respond to the 20-day EMA. The analysis will tell you which one this stock listens to. Hit rate. If price bounced off the 50-day SMA 6 out of 8 times over the past year, that is a 75% hit rate. Combined with the average bounce magnitude, you can calculate an approximate expected value for entries at that level. A 75% success rate with an average 8% bounce and a stop 3% below the average is a positive expected value trade. Trend changes in behavior. Moving averages that were acting as strong support in a bull phase often break down during a correction. AI will flag if the reliable level from 12 months ago stopped being reliable 6 months ago. That shift in behavior is itself a signal about the overall trend environment. Prompt 3 examines crossovers, not as mechanical signals, but as historical performance tests on this specific stock. Most traders apply crossover rules universally. The evidence says that crossovers work well on some stocks in some market environments and are nearly useless on others. The only way to know which category your stock falls into is to test it. Use this prompt. Analyze every 50-period SMA and 200-period SMA crossover that occurred for this stock over the past 5 years. For each crossover, identify whether it was bullish or bearish, the date it occurred, the price at the time, and how price performed over the subsequent 3 months, 6 months, and 12 months. Then calculate what was the average gain following bullish crossovers, what was the average loss following bearish crossovers, how long did price typically move in the crossover direction before reversing, and were there any false signals, crossovers that reversed within 30 days. This is backtesting a specific indicator on a specific stock. It is not perfect. Past performance is not a guarantee, but it gives you a statistically grounded answer to the question, does this indicator actually work on this stock? The crossover backtest gives you something most retail traders never have: evidence-based signal quality assessment. Average return. If the last 6 bullish golden crosses on this stock produced an average gain of 22% over 6 months, the signal has historically produced meaningful returns. If the average was 3% with high variance, it has not been a reliable generator of edge. False signal rate. How many crossovers reversed within 30 days? A high false signal rate, more than 30%, means the indicator is whipsawing in the current volatility environment for this stock. That should reduce your confidence in relying on the crossover alone. Leading versus lagging effect. On some stocks, the golden cross happens right before a major move. On others, it happens after most of the move has already occurred. The lag analysis tells you whether acting on the crossover gets you in early enough to make a meaningful return, or whether you are entering near the end of a move. The bonus move uses multiple moving averages simultaneously to identify the most significant price levels. When several moving averages converge at approximately the same price level, that cluster acts as a much stronger support or resistance zone than any single average alone. It represents the agreement of short, intermediate, and long-term trend participants about where the stock stands. Use this prompt, looking at the current positions of the 20-period EMA, 50-period SMA, and 200-period SMA on the daily chart. Identify any areas where two or more of these averages are within 3% of each other, forming a cluster. For any clusters you identify, what price is the cluster centered around? What does it represent technically given the trend direction? And how has price historically behaved when it approached similar clusters on this stock? Also identify the next significant cluster above and below current price. A stock sitting just above a cluster of the 50 and 200 at the same level has a very strong floor beneath it. If that cluster is also near a major horizontal support level, you have three technical reasons the same price matters. That is the kind of confluence that attracts institutional buyers. Moving averages are not buy and sell signals. They are a framework for understanding trend structure, identifying dynamic support, and testing whether specific signals have worked historically on a specific stock. Prompt 1. Trend structure. Determine whether the moving averages are properly stacked and assess how extended price is relative to each average. Prompt 2. Dynamic support and resistance. Identify which specific moving average this stock respects most consistently, and build a track record of bounce magnitude and hit rate. Prompt 3. Crossover performance. Backtest the golden and death cross signals on this stock specifically, not as a rule, but as a historical record of what has actually happened. Bonus. Cluster identification. Find where multiple moving averages converge, and treat those levels as the highest conviction support and resistance zones on the chart. Next episode, momentum. How to identify the stocks that are moving fastest relative to everything else, and why that edge is more durable than most people expect. See you Thursday.